Welcome back to the Neuro Finance Masterclass. Today, on day 121, we deconstruct the ultimate dual-engine compass of market momentum.
That's right, Ibrahim. Yesterday we completely unmasked price velocity using the RSI. But today we're officially entering phase 2 of this explainer series, and things are about to get intensely structural. We are diving deep into Gerald Appel's MACD indicator. We're going to strip away all the usual noise, ignore the typical amateur advice, and look at the actual, deep mathematical reality of how this tool captures momentum. Let's get right into it.
Okay, here is our rigorous algorithmic roadmap for today. First up, the dual-engine compass. Second, the mathematical anatomy of MACD. Third, we hit the absolute core, the power of the zero line. Fourth, a massive cautionary lesson on the crossover trap. And finally, we'll wrap it all up with the momentum audit.
Right, let's kick things off with Section 1, the dual-engine compass.
So, the MACD, moving average convergence divergence. Think of this as the ultimate bridge between everything we've learned about moving averages and velocity oscillators. The real beauty here is its hybrid power. It doesn't just track the direction of the trend, and, well, it doesn't just track velocity either. It does both of them simultaneously. Now, amateurs, they tend to use this tool completely blindly, right? Just waiting for lagging lines to tell them what has already happened. But as an architect, you're going to use it to capture macro momentum shifts early, literally before the rest of the market even realizes what's happening.
Moving into Section 2, the mathematical anatomy of MACD.
We really need to scale your quantitative neurofitness right now. Let's completely strip away those pretty visual charts for a second. The MACD engine is constantly calculating beneath your screen. To find our primary output, the MACD line itself, the system performs a very specific subtraction. It simply takes the 12-period short-term exponential moving average and subtracts the 26-period medium-term EMA. That's it. This line isn't just some random squiggle. It exactly measures the absolute momentum spread between short-term and medium-term price velocity. Let's map out the three distinct components making up this engine. First, you've got your MAC line, or the ANA-HOT, measuring that absolute distance between the 12 and 26 EMAs. Next is the signal line, the signal-HOT-D. This is actually a 9-period EMA of the MACD line itself, basically a smoothed mathematical trigger designed to catch sudden pivots. And finally, the histogram, the Hadjin-Barlary. Those are the visual bars in the background. They measure the exact mathematical distance between the MAC line and the signal line. When those two lines diverge, the bars visually grow, and when they converge, they shrink right down.
Which brings us to Section 3, the power of the zero line.
We are shifting our focus to the absolute center of the MACD grid, 0, or as it's known, the Sifr Hatta. Now, it looks like just a simple digit, but you absolutely have to stop seeing it that way. 0 is the structural dividing line of market regimes. It is literally the equator of market momentum. Everything, and I mean everything that happens on your chart must be judged by where it sits relative to this exact equator.
Let's clearly define these regimes. When the MACD line is above 0, the 12-day short-term EMA is mathematically greater than the 26-day long-term EMA, meaning you are in a structural bull regime. Buyers are in complete control. Conversely, when it's below 0, the 12-day is less than the 26-day. That's a structural bear regime, fully controlled by sellers. When that MACD line actually breaks above the 0 line from below, you are witnessing a massive macro shift from bear compression right into active bull expansion.
An architect treats this zero-line breakout as an institutional validation signal. We do not just trade random crossovers floating in the middle of nowhere. We track precisely where those crossovers occur relative to the zero equator. A breakout here, that's the footprint of massive institutional capital literally shifting the structural reality of the asset.
Now, for Section 4, the crossover trap. This is lethal danger. Because, look, with immense power comes lethal danger. I need you to pay incredibly close attention here, because this is exactly where amateurs get completely destroyed during phase 2 of their trading journey. Ask yourself this: if the MACD is so mathematically brilliant, why do amateur traders constantly destroy their capital using it? Why does blindly trading every single intersection lead to just massive portfolio drain? The answer boils down to one word: whipsaw. In a sideways, choppy trend, the MACD generates lethal false signals. Transaction fees and continuous bad entries will just bleed your account completely dry if you do not understand the structural context of the market you are trading in.
So this is where we build your algorithmic defense mechanism. In sideways chop, those 12 and 26 EMAs, they twist around each other constantly. The lines cross back and forth repeatedly, generating those lethal whipsaws. So we apply what we call the architect filter. You must absolutely ignore minor crossovers during low-volume chop zones. You only deploy capital when a crossover is supported by two things: an expanding histogram and a macrostructural shift near the zero line. Demand validation before you risk a single dollar.
And finally, Section 5, the momentum audit.
Okay, so this is your empowering cognitive task for day 121. We're going to apply these structural mechanics directly to the charts. Here is your protocol. Step 1. Open TradingView. Apply the standard MACD indicator with the 12, 26, and 9 inputs to your primary stock or core crypto asset on the daily time frame. Step 2. Locate the absolute macro peaks and troughs over the past year. Step 3. Deeply observe the histogram. Watch how the Hasim bar lines actually start shrinking before the MACD lines even cross. That shrinking visual distance, that is your elite early warning system for momentum decay.
We leave you with this core architect philosophy. Stop trading lagging lines blindly. Audit the spread, validate the zero line, and rule the cycle. The math is entirely visible if you just know how to read the structure. The ultimate question for you as we close this explainer is this: are you going to continue being whipsawed by reacting to lagging intersections, or are you ready to use the dual engine compass to structurally rule the momentum cycle? We'll see you in the next session.